Welcome to the Techno Fundamental Report for May the 2nd. Howard Marks quotes here, investment success does not come from buying good things, but rather from buying things well. There are three ingredients for success: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need that much skill. That's a great quote. Basically, what he's saying is you got to be at the right place at the right time. If you're at the right place at the right time, meaning a bull market, uptrending market, you're finding the next Walmart, well, that's about as much skill as you need. Now, don't try to catch a falling knife. That's one of the biggest mistakes out there. Basically, you may want to pause your video player because I'm just going to hit the key points here. Avoid cheap stocks. You really have to realize that, human behavior is designed where we're all taught that, if something's cheap or something has dropped a lot, therefore it's on sale. Like you could buy shoes on sale, but stocks don't work that way. Cheap stocks, the problem there is this. 90%, I would, it's my opinion that 80 to 90% of the volume on the exchanges, and I've actually read reports to this fact, is run by institutions. Now, the biggest problem these institutions have, one of the biggest problems is liquidity risk, where they can't buy these cheap stocks simply because there's not enough trading activity where they've got their billions or trillions of dollars to invest. It's very difficult for them to do something like this. So the institutions are going to avoid cheap stocks. And as a result, as a buyer of a security or an investment, you need somebody to come behind you and do additional buying to push the price of the stock up. So when you get into the cheap stock world, you're pretty much eliminating that demand. Buying on the way down in price, thus ensuring miserable results. So in other words, he's again saying here, this is William O'Neill, that when you've got a stock that's dropping, there's usually a reason. He talks here, he says, I bought Xerox when it dropped abruptly to a new low of 34 and seemed really cheap. A year later, it traded at 6. So a falling dagger can really mess you up. So here's an example. Here's Cisco Systems. Back in 2000, we talked about this one a lot recently, but the reason why is because it's kind of similar to the invention of the internet is kind of similar to what we're seeing with this AI stuff. Now realize that there were several companies such as Amazon and possibly Cisco, but there were just very few companies that came out of the 2000 dot-com bubble and are still around. I would say a vast majority of them don't even exist anymore. But anyway, with Cisco, you can see here it peaked. Everybody was red hot about it. Well, it drops, and so, it's on sale. We need to buy it, and then it drops. It's on sale. We need to buy it. It took 16 years for this stock to get back to this level. Now, a current example would be Intel. This is an old line blue chip company. They were pretty much involved in the invention of the personal computer. But you can see this dramatic sell-off here. This is not a sale or on bargain. There's something wrong here. The thing about the market is that you kind of have to think about it as a mystery novel. The market discounts the future. And if you're on chapter 1 of the mystery novel, more than likely the market's in chapter 10. So it already knows who the killer is. So when you think about efficient market hypothesis, which basically says, hey, all the information is out there, you have to realize that the buyers and sellers are what drive the price. So Walter Deemer says here, he says, a stock is not the same as the company. Now, this is a hard thing to get your mind around, but you have to realize that the stock is related to the company basically because of the earnings and the net cash flows and the dividends and all that kind of stuff. But day to day, year to year, it's going to depend on, are there more buyers than sellers? If there's more sellers than buyers, it's going down. If there's more buyers than sellers, it's going up. If they're in parity, it's going to go sideways. So the stock is going to operate based on the auction market. So it's just something you have to get straight in your head, and that's why we use technical analysis, because it helps us a great deal with with that particular issue. There is no such thing as a one decision stock. I've seen it happen many times where you get so emotionally involved in a company that you think, well, no matter what, I got to stick with it. Well, like I've always told you, my grandfather bought the passenger rail stocks, and he thought they were one decision stocks, such as New York Central, but the stock went to zero. Extremely crowded trades rarely work extremely well. So when you start to see where you turn on CNBC and they got a countdown going for an earnings report on a particular company, recently it's been NVIDIA, it's been things in the past like Cisco, where everybody thinks that this is the hottest thing going, and pretty much means to me that everybody's in it. So let's talk about the market. We've had a tough quarter here. First quarter was easy. This second quarter has been somewhat difficult. These are key moving averages here. This is the red is the 50-day and the blue is the 25-day. You can see the 25-day is actually crossing below it. We got this sell-off here. We somewhat of a rally. Now, I would say that, basically we are not making a new low here, but the trend is, we're not making a new high either. So the trend is somewhat down on the NASDAQ. Also, I've got this graph set up where we can see the trade meter. And you can see here, as long as that trade meter stays out of the green, I think that this is on basically on a sell signal. But it's just telling you the market's not going up right now. So let's look at the mid cap. Same story, breakdown, kind of a sideways action here. We're in the yellow on the trend meter. Let's go quickly here. New York Stock Exchange, same thing. We're in the yellow. Here's the small caps. Starting to act a little bit better. I mean, actually, if you go back and look at these various indexes, you'll see where this was somewhat starting to hold up a little bit here. And it's getting close to the green, but it's a reading of 53.51, and to be in the green, it has to be above 60. Here's the S&P large cap. You can see here actually turned down again here. The Fed did announce yesterday that they are not going to raise interest rates at this time, but the market's having a tough time with the inflation numbers. That's really the problem here, because if back in the 70s, I can remember, the Fed would raise interest rates, inflation would come down, then they would cut interest rates, and inflation would come right back, and the next thing you know, Paul Volcker's having to run rates up to 20%. I mean, that kind of situation. I don't think that's going to happen this time. I don't know. I'm not predicting. I'm just saying the inflation is the problem here. Now, this is the equally weighted S&P 500. The beauty of this particular, I've just added this indicator to these groups of indicators or indexes. Basically, every stock in the S&P 500 is not market cap weighted, but equally weighted. So you kind of get somewhat of a truer picture of what's going on with the broad market. Again, we're in the yellow, so we're not looking all that good there. Now, on interest rates, this is the power index. Really, there is kind of good news here, which is that interest rates are pretty much, this power index here says that for the last 125 days, interest rates have been down 4.19%. So it's basically saying that interest rates have kind of flattened out here and stabilized. That's really what we need, but we also need the inflation numbers to stabilize. Primary trend continues to be up. This is the S&P 500. This is the 200-day moving average. So the long-term trend is fine. We're going through a correction in here. Hopefully it doesn't get any worse. But basically what it's saying. So, I have to go back to the Copic curve that I talked about in the past. Now, remember, the Copic curve is all about establishing a market low. So when we went through the bear market of 2022, the market had a really, difficult time here. The NASDAQ was down 40%. The S&P was down a similar amount. It was the 2022 interest rates went from 0 to 5%, and it pretty much shocked the whole system. Well, the Copic curve, once it gets down below 0 and back above 0, historically, and we can look at it historically, it has always truly shown a market bottom. So far, this particular indicator, I give it a heads up, it's actually doing what it's supposed to do, which was to tell us that we were probably in a bottoming process in early 23. The aggression index is having a little trouble here. Again, this is where we're measuring growth stocks against consumer staples, technology versus toothpaste. You can see a breakdown here. It is holding this lower moving average, but if we just kind of look back at history here, you can see this breakdown held the lower moving average, rallied, and then really broke down. And this was, again, that bear market in 2022. You can see how devastating that ratio was. So we've had a good run here. I think we're going to probably go into some consolidation. Would really like to see us continue to hold that lower moving average. 3 economic indicators, you can again see where interest rates have been up, but stabilizing and actually kind of holding in a certain area. The price of oil has kind of turned down on us here. It's still above the 200-day, but I've noticed that the oil stocks are showing some weakness. Financial stocks are kind of just vacillating. You know, what we're referring to the market right now is what we call the big churn. We're just going up and down. We're not making any progress to the upside during this quarter, but we're consolidating probably the gains from the first quarter. Well, if you have any questions, please let me know.